There are three important elements in your investing journey. The capital, which is the money that you have for investing, and the whole lot of time, the period or the number of years that you can let or allow that money to compound. And the other important element will be the vehicle or the opportunity into which you are putting this money. We always say that you should invest in opportunities that you understand very well. That stretches to the opportunities or the vehicles into which you are putting your money into. If you don't know what the fund manager, what the company to which you are buying shares, or the business, the individual whom you are lending your money, if you don't know what they do to generate the returns that they pay you, you better not give that money away. You better not invest in that vehicle. It's very important to have a knowledge, a broad knowledge into what these individuals, the fund managers or the corporations do to generate the money that they share with you as a return. But if you only choose to be blinded or to go the route of looking at the rate of return alone, you might be prepared for some surprises. This video today brings us into understanding unit trust sub-funds. When you talk of mutual funds or unit trusts, the collective investment schemes that draw investment funds or money from different or many people and putting it into one basket that we call the fund, these individuals or the persons who have put their money as investors into that fund, will call them members of that fund. Then their money is used to purchase units of the fund, where in most cases, a unit of a fund is valued at 100 shillings. So we have different types of funds with different characteristics or fund profiles. We shall limit this video to two unit trust sub-funds. That is the money market fund and a fixed income fund, so that we draw an understanding between the two, and possibly we will be able to understand the reason why we have 25 operating money market funds out of the 39 registered money market funds, and on the other side we have only 10 operating fixed income funds, which are sub-funds held or operated by fund managers or operating money market funds. What does that draw in your mind? It brings a thought, or it should have shown some light that this question of diversification as a form of protection or risk minimization factor when we talk of the asset allocations. Where asset allocation, we draw that one to a requirement. Let me call it a legal requirement under the regulatory frameworks by Capital Markets Authority that the fund manager, in order to minimize the risk exposure of the fund, especially the money market funds and the fixed income funds, they are required to split that fund or the money they are investing into at least 4 asset classes. That would simply be interpreted that no asset class is supposed to gobble or take more than 25% of the fund. The meaning that it's protecting the members against losing a huge amount that is beyond 25% of the total amount that they have put in the investment basket in the event that that asset class default in paying back the capital or the returns expected from that investment. I'm narrowing to an asset class because the many factors that would affect a particular industry would not spare a player in that industry, all the players in the same industry will be more or less averagely affected in the same way. This is to say, if we have more than 25% of a fund sitting with the government securities, in the event the government was to default, which is unlikely, then it means the members of that fund would have lost to the tune of the amount that was invested in that asset class. If you have invested in a corporate bond of a particular company at an amount that is more than 25%, in the event that company goes under or faces economic challenges, then it means members of that fund would have lost to the tune of the percentage of the fund that is rested with that person. So that is to say, or to interpret, that you are averagely secured, protected up to 75% of your capital, because there is an allowed exposure of a maximum of 25%. And those are the grounds that the fund manager has to work in to ensure that the whole fund is protected. That is the scenario, or the highest exposure expected under the regulation. But when you narrow down and analyze the fact sheets, the asset allocations by the different fund managers, is that a reality? Does that information or that requirement trickle down to those fact sheets? In our earlier video where we are examining the top 10 money market funds, it is clear that some money market funds or some fund managers have opted to invest way beyond 80%, 60%, 70% of the fund into one asset class. What does that tell you as an investor? That informs you as an investor that there is a burden of responsibility that rests on you on the matters of evaluating the adherence by your fund manager to regulations. Those regulations protect you again and your capital against such exposure. The other thing, we'll look at diversification or the spread of risk across sub-funds. Yes, we have that asset allocation or spread in one fund, but it will also be important to consider the fact whether this fund manager offers you other opportunities of maximizing your returns. Because unit trust investment is not tied just to money market funds. We have fixed income funds, which are commonly known as bond funds, and we will look at the reason why they are referred to as bond funds. Then we have wealth funds, which are also under unit trust. We have balanced funds, we have equity funds, and others, including special funds. But now, one thing that is important to observe when you compare the fund profiles of money market funds and fixed income funds held by one fund manager. For example, if you look at the fixed income fund and the money market fund as two sub-funds under Etika collective investment scheme or unit trust, or you go for a money market fund by Britam and a fixed income fund by Britam. I'm using those examples because majority of the the fund managers who are operating money market funds do not have other sub funds. A good example is Zimele and NCBA had money market funds, and after a long period of time trading in money market funds, instead of creating another sub funds, they transitions the entire portfolio of their money market funds, the members and the fund amount, to the fixed income sub funds, eliminating or stopping the operation or investments in the money market funds. Having multiple sub funds and the unit trust investments is another form of diversification that you get from your fund manager. What does that tell you? You have an opportunity of splitting the build up in your money market fund and investing or transferring that amount to another sub fund that offers you different or another set of advantages when you compare it with the money market fund. But there is a close relationship in how the fixed income fund operates when you compare it to a money market fund. I'm sparing the wealth fund because I want us to tackle the wealth fund in a separate video because of other interests. It stands a bit different when you compare it with these two that for me, and as this channel observes, they are closely related. But the differences between the money market fund and the fixed income fund is what makes the fixed income fund different and stand out. The good characteristics or the attributes that we narrate for money market funds, that is affordability when it comes to your initial investment amounts and the top-up amounts, where we have classified that the minimum that you are expected to invest in a money market fund is 100 shillings as posted by Etika, and a bit silent because Zimele Money Market Fund, as we have seen earlier on under the Zimele video, has transitioned fully to a fixed income fund. So Etika remains the only money market fund that is tapping investors from the bottom of the pyramid, giving us proper financial inclusion. The other one is convenience. Convenience by the fact that you are able to interact with your account, whether you are withdrawing, whether you are investing, whether you are viewing the balances or the statements, by the comfort or convenience that comes with technology. Then there is flexibility. You can access, withdraw your money, deposit your money anytime without any limitation. The other one is security. Security because these funds are regulated both by CMA and RBA for those fund managers who are also managing retirement funds. But I want to put a caution at that point. A very important caution because most investors think that the responsibility to protect your investment and performance of that fund stops with the CMA. CMA has no responsibility over the protection of your capital, protection of your fund, or the performance of that fund. That responsibility squarely lies with the trustee of that fund. It is the trustee's responsibility to ensure the performance of the fund and protection, security of the capital or funds of the investors. The Capital Markets Authority its oversight relies on adherence to the regulations only. And many fund managers will go back to Capital Markets Tribunal to seek for extension of time before they adhere to regulations that are supposed to put that or fix the fund. So important, keep checking the trustworthiness of the trustee as opposed to CMA. Trustee is the one who is responsible for that protection. So lastly but not the least, when it comes to the comparability of the money market fund and the fixed income fund, is that those attributes, they are the same. The liquidity aspect, the lack of locking periods, easy accessibility to funds, and everything, they are the same between those two funds. But here are the differences, and I only want to give you 3 differences between a money market fund and a fixed income fund that you need to know as an investor, and make a use of them when need arise in order to maximize and leverage on your investment. And the first one is benchmark of the return that the fund manager will give to your investment. Money market funds, the return is benchmarked on the average return or the average interest rate of a 91-day treasury bill. Then the return on a fixed income fund is benchmarked on the average interest rate of a 182-day treasury bill. That is very important. So if you take the average, means that we are taking the different interest rates posted by auctions of the treasury bills over a period of time. And it is important to remember that treasury bills are auctioned or issued on a weekly basis. So we'll be taking for a whole year the different rates posted in those auctions and taking an average. That average is what your fund manager benchmarks the return that is paying you on a money market fund. The average that is posted on a 182-day treasury bill is the benchmark that the fund manager gives you a return on the fixed income fund. And that is very important for an investor. If that is the promise or is the benchmark on what you're supposed to pay me as a return as an investor, then it is simple to say that if my fund manager is giving me a return that is below the benchmark, my fund manager is underperforming. If my fund manager is giving a return that is above what is the benchmark or equal to the benchmark, that fund manager is performing or over-delivering on the promise as an investor. And for purposes of maximization, then I'm free to commute or move my funds from an underperforming fund manager to the one that is giving me or performing as per the benchmark rate. Because as an investor, once you buy those units in that investment, you are not buying shares of the company. So whatever profits that the company makes, you are not a partaker of that cake. You will not have a share unless you buy shares of the company. So your return is only limited to what is posted by the performance of the fund where you have invested. So always look at the fund profile, what that fund profile is promising to give you or to benchmark. And because you always have that information relating to the average interest rates of the treasury bills, then that should guide you on your next course of action. Difference number 2 is the market to which these funds are limited to. Where does the fund manager, as per requirement, invest the funds collected? And as the name point out, the money market fund is limited. Its investment is limited to the money markets. Remember, all these collected funds are made available to the users of capital. And the capital is mainly sourced from the capital markets. And as per my earlier video, under capital markets, we divided that market into two. And we said there is a money market, which is the market where we will get buyers and sellers of short-term securities, or those in securities that are supposed to mature in a period of not more than 12 months. Then we have the capital market, which is now the name reserved for the market that will get the buyers and sellers of long-term instruments. Those are stocks, bonds, and other instruments that should mature in a period that is of more than 12 months. Also important to note is that as per regulations revised by Capital Markets Authority, the fund managers in maturity or horizon of their investments in the money market was stretched from 12 months to 18 months. Because as a distinction, as we say that the money market funds or the fund is specifically invested in short-term securities which are found in the money market, And the fixed income fund is not limited. The fund manager can invest both in the short-term securities in the money market and long-term securities in the capital markets. But it's notable, after this regulation was revised and we commuted the upper or the horizon of the short-term securities from 12 to 18 months, we brought the competition closer between the money market fund and the fixed income fund. And that, as per this channel, kinda informs the transitioning of money market funds to the fixed income funds. But because fixed income funds receive lesser hairplay, lesser influence, most people have kept their investment under the money market funds because of lack of a lot of information, enough information to inform their decisions about the fixed income funds or the bond funds. That is very important. And having said in the first distinction that these instruments, the return in the fixed income fund is benchmarked on a 192-day treasury bill return, and the money market fund is benchmarked on a 91-day bill return, you would notice that from this kind of schedules is that always, because return is also dependent on the duration or the maturity, the horizon of that security. It simply means that 182-day treasury bills will post a higher return percentage or a higher rate compared to the 192-day. In our recent auction of treasury bills, in the last 12 months, the 91-day treasury bill posted a return that is less than 15%. It was about 14.990. But the 182-day treasury bill still posted in the region of 16.3%. So that distinction then should inform the fact that we expect the fixed income funds to generate or give us a higher return compared to what the money market funds should be giving us. But remember, as I had said earlier, is that we are talking of the average return, where average takes the different posted returns over a period of time and we consider the average. And for that reason, that is why the money market funds have posted a notoriety of higher returns than fixed income funds for that time. But as a third distinction based on those two distinctions is that in the long term, a money market fund is supposed to give you an averaged lower return compared to the average return that you get from a fixed income fund in the long run. Therefore, that says if you are investing for the long haul, if you are investing for a long period of time, it's good to consider the fixed income fund. But for the purposes of the emergency funds and your sinking funds, emergency funds, the money market fund suffices that. And therefore, based on those securities, and the difference is that a money market fund and a fixed income fund, because they majorly share common characteristics, and their investments is that they both enjoy low risk profile. They both enjoy low risk profiles. With that information, I believe you now get some understanding to compare the two sub-funds of the unit trust investments. Thank you for your time and thank you for watching and your loyalty to this channel. See you in the next video.